Ladies and gentlemen, good day and welcome to the Hindware Home Innovation Limited Q4 FY26 earnings conference call hosted by Arihant Capital. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ronak Ostwal from Arihant Capital. Thank you, and over to you, sir.
Thank you. Good evening and welcome everyone. On behalf of Arihant Capital, we invite you to Hindware Home Innovation Limited Q4 and FY26 earnings conference call. From the management side, we have Mr. Nirupam Sahai, CEO of Bath and Consumer Appliance Business, Mr. Rajesh Pajnu, CEO of Pipe Business, Mr. Sandeep Sikka, the Group CFO, and Mr. Naveen Malik, CEO and CFO of Hindware Home Innovation Limited. Kindly note that some of the remarks or observations made during today's call might be forward-looking, such as financial projections or statements regarding company's plans, objectives, expectations, or intentions. The company does not have any obligation to revise this forward-looking statement to reflect any further events or developments. For a comprehensive disclaimer, please refer to slide number 2 of the result presentation. With that, I would now like to hand over call to the management for their opening remarks, post which we will open for Q&A session. Thank you, and over to you, Mr. Naveen.
Good evening, everyone, and welcome to Hindware Home Innovation Limited FY26 and Q4 FY26 earnings call. Kindly note that some remarks and observations made during today's call might be forward. These may include, but are not limited to, financial projections and statements regarding the company's plan, objective, expectations, or intentions. The company does not have any obligation to revise these forward-looking statements to reflect any future developments or events. For a comprehensive disclaimer, please refer to slide number 2 of results presentation. For FY26, the company reported consolidated revenue of 2,510 rupees 2,520 crore in FY26. EBITDA rupees 233 crore against 184 crore last year, registering a year of 27%, with EBITDA margin at 9% compared to 7% corresponding period last year. Profit before tax and exceptional item was 40 crore compared to negative 28 crore 25. FY26, the company reported consolidated revenue of 663 crore compared to 699 crore in Q4 FY25. EBITDA for the quarter stood at rupees 63 crore versus 51 crore last year, up 23% year-on-year, with margin at 9% compared to 7% in Q4 FY25. Profit before tax and exceptional item for the quarter was 15 crore as against rupees 2 crore in the corresponding quarter last year. As communicated on our previous investor calls, in a strategic move to sharpen our focus on the kitchen appliances segment, including chimneys, hobs, and cooktops, the board has approved the discontinuation of loss-making product categories such as air coolers other than through the e-commerce channel, ceiling and other fans, air purifiers, water purifiers, and furniture fittings. Please refer to note number 3B of this financial for further details. With that, I now hand over to Mr. Nirupam Sahai to take you through the Bathware and Consumer business. Over to you, Nirupam.
Thank you, Naveen. For FY26, the Bathware business reported revenue of 1,520 crores compared to 1,384 crores in FY25, reflecting a year-on-year growth of 10%. EBITDA stood at 157 crores against 121 crores last year, registering a year-on-year growth of 30%, with EBITDA margins of 10.3% for FY26 compared to 8.8% for FY25, a growth of 160 basis points. Profit before tax was 48 crores in FY26 compared to negative 1 crore in FY25, a positive year-on-year increase, with PBT margins at 3.2%. For quarter 4 FY26, the business reported revenue of 397 crores compared to 360 crores in Q4 FY25, representing a year-on-year growth of 10%. EBITDA for the quarter stood at 38 crores versus 38 crores last year, with a year-on-year growth of 20%, and EBITDA margin of 9.5% in quarter 4 FY26 versus 8.7% in quarter 4 FY25. Profit before tax for the quarter was 11 crores as against 2 crores in the corresponding quarter last year, with PBT margins of 2.9%. The financial figures quoted above are excluding other income and exceptional items as reported in the earnings presentation uploaded on the stock exchanges. While the overall demand environment remained relatively subdued during quarter 4 amid macroeconomic softness and geopolitical uncertainties, the underlying trajectory of the business continued to remain stable. Our sanitaryware and faucets businesses delivered healthy growth during the quarter. However, the tiles business witnessed temporary supply disruptions due to fuel shortages faced by our manufacturing partners. This in turn impacted product availability and consequently affected sales of tiles during quarter 4. At the beginning of FY26, we had clearly outlined our strategic priorities for the Bathware business, and I'm happy to share that we remain committed to that roadmap throughout the year. The consistent execution of these priorities helps the business deliver steady growth and improvement in profitability despite a challenging operating environment. Our strategy remained anchored around premiumization, strengthening engagement with our weighted dealer network, expanding distribution across Tier 2 and Tier 3 markets, and deep engagement with influencers. During the year, we continued to make steady progress across each of these areas, further improving market penetration and strengthening our revenue mix. Both our institutional and general trade channels delivered growth during the year, supported by expanding distribution reach and improving brand traction across key markets. From a channel perspective, both institutional and general trade channels delivered steady growth during the year, despite a challenging demand environment across parts of FY26. The revenue mix remained healthy, with retail as the primary contributor and institutional business contributing 25%, with both channels delivering growth and supporting a balanced, diversified demand profile. Alongside this, we continue to invest in the Hindware brand as part of our long-term equity building approach. This is now translating into stronger awareness and improving consumer preference metrics across key markets, with increasing salience relative to peers. The business also witnessed continued cost pressures during the year, particularly in fuel, brass, and other key input materials, driven by geopolitical developments and commodity volatility. While we undertook calibrated price increases and operational efficiency measures, part of the margin improvement was offset by these inflationary pressures. Alongside growth initiatives, we also remain focused on improving operating efficiencies and strengthening the balance sheet. Through tighter receivables management, inventory optimization, and supply chain efficiencies, working capital days improved from 103 days in FY25 to 89 days in FY26. The net bank debt also reduced from 308 crores to 234 crores during the year, reflecting stronger cash flows and continued financial discipline. Capacity utilization for FY26 for our sanitaryware plants stood at approximately 82%, while the faucet plant operated at 89%, supported by improving demand and operational efficiencies. As we look ahead to FY27, we remain firmly focused on driving profitable growth across the business, while continuing to strengthen execution across our strategic priorities. We have started the year on a very encouraging note with healthy momentum across key categories and markets. Based on the business momentum we are witnessing over the last couple of quarters and improving market conditions, we remain confident of delivering growth in the range of 15 to 20% in FY27, along with an improvement in margins. Turning to Hindware Home Innovation Limited, Quarter 4 26 revenue stood at 80 crores, with EBITDA of -7 crores. For FY26, revenue was 370 crores, with a negative EBITDA of 12 crores. As communicated during our Quarter 2 update, we had initiated a strategic portfolio rationalization exercise focused on exiting loss-making categories and sharpening our focus on segments where we believe we have stronger market positioning and sustainable competitive advantage, particularly in kitchen appliances and water heaters. Consequently, year-on-year comparisons are not entirely like for like, given the discontinuation in FY26 of categories in general trade such as air coolers and fans. We continue to remain disciplined in executing the strategy through FY26. Alongside this, we focused on premiumization and new product introductions across the portfolio. As a result, the business is now witnessing an improved product mix and stronger underlying profitability metrics, the benefits of which are expected to become increasingly visible from Q1 onwards. The quarter witnessed operational challenges where input cost volatility and intermittent availability of key raw materials impacted sales execution. In addition, margin performance was partially offset by continued cost inflation across key input materials, driven by geopolitical and commodity price pressures. FY27 will be a year of sharper execution, stronger technology integration, and focused category-led growth. As part of the strategy, we are launching our AI-enabled chimneys range, which reflects our focus on bringing smarter and more differentiated products to consumers. Over the years, we have built meaningful scale and leadership in the category, and we see a strong opportunity to further strengthen this position through continued technology adoption. You will also see innovation across our kitchen appliances and water heaters portfolios. This is aligned with our premiumization strategy as consumers are increasingly seeking design-led, feature-rich, and technologically advanced products. We have started the new financial year on a very healthy note with encouraging performance in April. As we continue to sharpen our focus on select high-potential categories, improve product mix, and drive operating efficiencies, we expect meaningful operating leverage to come through over the course of FY27, supporting a stronger profitability trajectory. At the same time, we are seeing consumer purchase journeys evolve rapidly, with customers increasingly researching products in this space online before making buying decisions. In line with this shift, we are strengthening our positioning as a digitally led consumer brand through focused investments in digital marketing, content, consumer engagement, and platform visibility. Alongside this, we are also deepening our presence across modern trade, working closely with both national and regional retail partners to further expand reach, strengthen brand visibility, and improve market penetration. With that, I now hand over to Mr. Rajesh Bajnu to take you through the pipes and fittings business. Over to you, Rajesh.
Thank you, Nirupam. Good evening and thank you all for joining us. FY26 was a challenging year. Raw material volatility, unseasonal rain, subdued infrastructure spending created a difficult operating environment across the sector. In Q4 FY26, our revenue stood at 186 crores with an EBITDA of 10 crores and a negative PBT of 10 crores. And for FY26, the company reported revenue of 673 crores, EBITDA of 41 crores, and a PBT loss of 29 crores. The financial figures quoted above are excluding other income and exceptional items as reported in earnings presentation uploaded on the stock exchange. In Q4, the industry witnessed a sharp increase in PVC resin, with prices moving from approximately 68 rupees per kg to 114 per kg by March. This rapid escalation created a short-term demand acceleration and pricing opportunity across the market. Over the last 2 years, the industry, including us, had largely been operating on lean inventory levels amid continued raw material price volatility. Our strategy remained focused on maintaining working capital, discipline, and minimizing inventory-led risks during periods of sharp price correction. However, during the sudden spike in resin prices in March, due to this geopolitical affairs, players carrying relatively higher inventories were better positioned to capitalize on the surge in market demand and temporarily supply tightened. While January and February witnessed healthy demand momentum, March was impacted by supply constraints and cautious channel behavior due to extreme raw material volatility. As a result, despite healthy underlying demand conditions, we witnessed a revenue shortfall during the month of March 26. The limited inventory availability during this period also impacted operating leverage and profitability, resulting in lower operational EBITDA and a PBT loss for Q4. On the operational front, as shared in our previous call, the Roorkee plant now became operational towards the end of January. I am pleased to share that a ramp-up is progressing as planned and the project remains firmly on track. As we move through FY27, we expect volumes from Roorkee to scale progressively, with a more meaningful contribution anticipated in the second half of FY27 as utilization levels improve. For our business, working capital has been maintained at 90 days and net bank debt has increased from 385 to 429 crores during the year, primarily on account of the capex expansion for the Roorkee plant. With the expansion phase now complete, our focus in FY27 will be on driving full utilization of this capacity, improving operational efficiency. During the year, we also expanded our SKU basket and strengthened distribution reach in key markets. As we enter FY27, we are beginning to see early signs of stability returning to the market. April was a very strong month for us, and we are seeing momentum gradually build. While we remain watchful of external factors, we are encouraged by the trajectory of demand and expect the second half of FY27 to be stronger than the first. On the strategic front, we remain focused on expanding our product portfolio, strengthening our manufacturing footprint, and improving operational efficiencies across the business. We believe the investments and initiatives underway today will further strengthen our competitiveness position and support sustainable long-term value creation for all stakeholders. With that, I will now hand it back to the moderator to open the floor for questions. Thank you all.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to please use handsets while asking a question. Ladies and gentlemen, we will now wait for a moment while the question queue assembles. Our first question comes from the line of Maitri Shah with Sapphire Capital. Please go ahead.
Yeah, hello. Am I audible?
Yes, ma'am.
Yeah, hello. Good evening. A few questions from my side. Firstly, on the growth. So, we mentioned that we are looking at a 15 to 20% growth in the Bathware side, but our pipe business kind of degrew this year. We've also added capacity there, and we've also exited a lot of the loss-making side in the home innovation. So, any kind of color on the growth we're expecting in these two verticals?
In consumer appliances, we are also targeting 15 to 20%.
Okay. And do we expect...
Pipes business,
yeah, sorry, please go ahead.
As regards pipes business, see now the prices which I was talking about from 68 to 140 rupees. They were stabilized at around 80 rupees. So we are looking out for a increase of around 15%, 14 to 15% in volume.
15% at all. Okay. And could you repeat what was the price increase or decrease? I couldn't hear you.
Yeah, it was around 68 rupees per kg, the raw material prices in January, and by the end of March it was 114 rupees.
114 rupees. Okay. And on the home innovation side, when do you see this business turning a bit positive and then that positive? At what scale of operations do you think this profitability would kick in?
We expect it in Q1 FY27 itself, and the full year will definitely be positive. So all the actions we've taken in terms of rationalization of portfolio, launch of new products, premiumization, etc., all of them are paying off already. We expect positive profitability in Q1 itself.
And any kind of color on how do you see the pipe business growing? Like any drivers do you see for this 14-15% volume growth, or is it on the basis of new capacity addition that now we're not constrained by capacity anymore?
See, ma'am, as we said that till January we were doing fine. All these constraints came because of all these positions which are happening now around the world and because of the raw material volatility. We were not able to catch up with this pace in the month of March because of our low inventory. And if you see now what we said in my opening remarks, that all those orders which we are carrying, we are just able to do 50% of our business, what we did in last year, March. So we have done that in this April. We have grown in April last month by around 50%. We are still growing in this month YTD around 30%. So that's why we are giving this statement that we are looking for a very positive year.
You've grown in April by 50% to 50 or 15?
50%.
Oh, okay, that is great. And we're able to now pass on the cost, so there's no lag coming in from there.
Yeah, it's now because we could with inventories also. So we look forward for a bright future.
Okay, that is good. And we do see a lot of inflationary issues coming in and impacting the consumption of the buyers. So do you see that kind of hindering our growth for the home innovation and the bathware sector, because we're mostly catering to the retail side on both of these? So any sort of like headwinds we might face not achieving the growth?
So there are obviously some cost pressures in terms of gas prices, brass prices, etc., raw material volatility. Having said that, we've taken price increases in both sanitaryware and faucets, both in January and then again in April, May, to ensure that margins do not get hit. We have not seen a major impact on sales as a result of the price increases, because it's pretty much happened across not only our industry but across different industries. So we've and with the growth momentum that we're seeing so far, we are confident of hitting the 15 to 20% growth number that we outlined earlier.
Okay, that is great. And any sort of overall consolidated margin number you would like to target for FY27 and then post that for FY28?
Yeah, I think we should be able to grow by somewhere in a range of like the 5 Q4 was abnormal. Mr. Pajnu has already spoken about it. But our plan is to expand our overall margins from the business on a consolidated basis, ranging 1.5% to 2% systematically, at least for the next 2 years.
Okay, so 1.5 to 2% annually we'll be looking at a rate for the next 2 years.
Yes.
Okay, that is great. Thank you and all the best.
Thank you.
Thank you.
Thank you. Ladies and gentlemen, if you wish to ask questions, you may please press star and 1 on your touchtone telephones. Our next question comes from the line of Vinod Krishna with Avendus Wealth. Please go ahead.
Sir, am I audible?
Yes.
So my question is regarding the bathware business. So however, if you remember, we had a very tepid performance because of losing market share, and not in a big way, but the good market share in both the segments. So how is the positioning now, and if you can comment about the competitive intensity in terms of number of players? I'm not asking the name, and how is our position in both sanitary and faucets, if you can go deeper in this to make us understand is there any new competition, how is the growth, and what is our aim? Like we used to say, we want to grow 1.5 times the growth of the industry. So how are we thinking about these things?
So we shared in Q3 that the bathware business grew at 14%, and in Q4 we just shared we've grown at 10%. That 10% was tempered by the fact that we didn't get supplies of tiles at the end of February and March. That would have added about 2 to 3% to the growth. Seems steady growth of quarters now, and we think that the overall growth that we have of and therefore we.
Sir, your voice is being. I don't know if we're not able to listen to you. It's being cut. I don't know if it's the same for everybody.
Yeah, I'll repeat.
Yeah.
Can you hear?
Yes, sir.
So in Q3 FY26, the bathware business grew at 14%. In Q4 FY26, we've grown at 10%, but that was affected by non-availability of tiles from our suppliers in the end of February and March. If we had got supplies as per plan, that would have been additional 2 to 3% of growth overall. So we've had strong double-digit growth in Q3 and Q4. And like I said, we've started this financial year well as well. So we have the growth momentum. Last year, with the kind of growth that we had overall, which is 10% for the full year, we believe that that is higher than the market growth rate, and therefore we have gained market share in FY26. With the 15 to 20% growth that we've targeted for FY27, we are again confident of gaining significant market share in this financial year. So the confidence is high. We've grown well in both sanitaryware and faucets. And we believe that the growth momentum that we have going forward for this year, again in both sanitaryware, faucets and tiles, is going to be in double digits. So we're very confident of the 15 to 20% growth that we've talked about. It's underpinned by strong strategic plans and very strong execution on the ground. So I think there's full confidence on the fact that we will grow ahead of the market and therefore gain market share.
So, sir, any comment on the competitive intensity? How many players across segments? If you can just give a, because when we see different regions, different players. So, at the national level, how many players do we compete with in bathware and sanitary and faucets? Just the number of players normally.
Yeah, so at a national level, there are 5 or 6 major players. So you have some regional players, but a large part of the industry is concentrated in the top 5 or 6. So the real intensity of competition across the country is among the top 5 or 6 players. You do have some regional competition, but not that significant. The good thing is the organized sector in this industry is very strong. So basically, we do have a large proportion of the sales in the organized sector, and within that, these top 5, 6 players. I won't name the players, but basically, we have 5 competitors.
But would we be in the top 3, sir, in both faucets and sanitary?
Yes, absolutely.
And we are confident about, so you said you are confident about double-digit growth next year. So in the next 2-3 years also double-digit growth. And what are the factors do you think, sir, if you see, is it distribution? Is it what did we do, or what are the tailwinds that we are seeing that we are confident about double-digit growth next year? And can you comment about the growth in the medium term also, and what are the factors driving
Yeah, so I'll talk about what has driven growth over the last couple of quarters and what is going to drive growth in this year, and that momentum will continue into the coming years because that strategy fundamentally will not change. One which I've talked about consistently is a focus on weighted dealers. So large dealers across the country. So city by city mapping of the weighted dealers, making sure that if we are present there, we increase our share of wallet, and if we are not there, we enter those counters. We did that very successfully in FY26, and we'll continue that momentum. We've seen very high double-digit growth from the weighted dealers that we focused on. So that focus will continue in FY27 and going forward. The second is in terms of increasing distribution in Tier 2 and Tier 3 towns. We focused a lot on that over the last year, and we plan to continue that momentum, so that will help to drive growth as well by deepening our penetration in Tier 2 and Tier 3. The third is in terms of premiumization and new product introductions. We've had a very successful set of new product introductions in FY26, which are contributing majorly to sales and also contributing to the improvement in profitability that we are seeing of 160 basis points for the year. Also, Sorry, sir. Go ahead, sir. Sorry. Yeah. Also, our efforts in terms of deepening engagement with influencers, with plumbers. We are actually the only bathware company which has 1 lakh plumbers registered on our app. And the number of active plumbers on the app is increasing every month. So both in terms of absolute numbers and active, which means actually transacting on the app, that has gone up dramatically over the last 6 months, and we continue that momentum. We're renewing our focus on architects, so both in the institutional space as well as through the general trade. Focus on architects and interior designers is going to strengthen in FY27 and going forward. So through a combination of focus on weighted dealers, increasing our distribution in Tier 2 and Tier 3 towns, premiumization and launching new products to fill gaps either at price points or in terms of consumer benefits, and deeper engagement with influencers. I think all of those have really helped us to grow and to grow profitably. Will continue this year and in the medium term as well.
So then last follow-up question, when will we get back to our mid-teens margins, EBITDA margins that we used to do? Because we also, I don't know, 1 year back in the con call, Sandeep ji mentioned that there's a huge gain we made in our manufacturing process in terms of reducing our wastage or something like that. Maybe I'm wrong. Better throughput. So when will we get back to our mid-teens, or mid-teens is not there? We should not model or a medium term also EBITDA margins for bathware.
So the objective that we've set for ourselves and we're confident of delivering on is a 1 to 2% improvement in the margin year on year. So in this financial year, we've already hit EBITDA margin of 10.3%. We're confident of delivering about between 1 and 2% improvement in the EBITDA margin in this financial year, and another 1 to 2% in the next year as well.
So we will go to 15, 16 and stop there? That would be our peak, or 14. So what would be where will we go and mostly Yes.
Right now, I'd like to talk about the outlook for the next 2 years, and then obviously we'll reevaluate where it can go after that. But yeah, so we will hit the teens within this year and next year.
So can you, where are the margin gains coming, sir? And thank you, sir. This is the last question.
So manufacturing efficiencies, so better capacity utilization of the plants, operating efficiencies of the plants which we focused on, and then launching a lot of new products at higher gross margins. The premiumization strategy that I talked about also helps in terms of profitability. So really focusing on our mid-premium and premium ranges to improve the profitability mix. So those are the two primary growth drivers in terms of profitability.
Thank you, sir. Thank you very much for all this.
Thank you. Participants, to ask a question, you may press star and 1. Our next question comes from the line of Yash Mantu, an individual investor. Please go ahead.
Hi, good evening, and thank you so much for taking my question. Can you please talk about the industry size for both sanitary and faucetware? Because I remember you used to give that number in the presentations, but I think you have stopped giving that number now. Can you please give that number?
So the sanitary ware market size is roughly about 7,000 to 8,000 crores. And the faucets market is roughly about 13,000 to 14,000 crores. So it's a larger market.
Okay. Thank you. And when you talk about a 15 to 20% growth in bathware, how much would that be coming from sanitary and how much would that be from faucet?
So sanitary ware will be in the early teens, and faucets will be a few 3 or 4% higher than that.
Okay. And any comment about the volume growth and the price growth? Because I remember we have already taken a price growth in the last quarter.
Yes, we've taken a couple of price increases over the last 4 months. So we are looking at, because of the premiumization and the price increases, we are looking at a volume growth which will be marginally lower. So the value growth that we're talking about, 15 to 20%, will be marginally higher than the volume growth because of the premiumization strategy.
Okay. And can you please tell me about the customer base when we talk about tier 1, tier 2, tier 3 cities? How much would that be coming from tier 2 and tier 3 cities especially?
Yeah, so we have roughly about 35% of our business coming from tier 1, roughly about 35% coming from tier 2, and roughly about 30% coming from tier 3.
Okay. Sir, actually I asked this because for about 3 years now, our real estate absorption and the new launches have been going down, especially when we talk about homes that are priced lower than 1 crore. So how do you think that is going to affect our company in the near term?
So I think there is a huge amount of that is still happening in the metros and tier 1 and tier 2. In the metros, what we are seeing is that more of them are at the mid-premium and premium range. So a lot of the new launches are actually at slightly higher prices than they were 2 or 3 years ago. So the trend that we're seeing in the industry is a move towards premiumization, people buying higher value products, because I think the homes that they're purchasing are at a significantly higher price than they were earlier. So we are seeing that trend, and therefore that focus on meeting that emerging consumer need of more premium products.
And is the company, I don't want to name the competitors, but isn't it true that some of the really premium brands are making inroads because of this premiumization in the real estate industry?
Yes, so I think in general, the premium ranges of most companies are increasing in terms of size. But in response to an earlier question, I talked about the top 5 or 6 players basically in sanitary ware and faucets. I think the key is actually within these 5 or 6 companies. So we are focusing on a 3-brand strategy. We have Kio, which is our premium brand, Hindware Italian Collection, which is mid-premium, and Hindware, which is mass. So a lot of the focus is in terms of Hindware Italian Collection and Kio, both in terms of distribution, penetration, and in terms of the new product introduction. I talked about the positive impact of that on gross margin as well. So that is really the focus, is where the consumer need is actually coming.
And so just one last question from my end. We have been talking about this discount thing in the whole industry now. So do you think that is something that we are going to get rid of in, let's say, a couple of years, or is that something that might go on for long term?
So discounts in general in this industry are not really out of line with what is there across different industries. So I don't see a significant impact of discounts on overall profitability. It's more or less in line with what is required. It's not really disproportionate.
Okay. Okay. Thank you. Thank you so much, sir.
Thank you.
Thank you. Our next question is from the line of Fenil Brahmbhatt with Choice Institutional Equities. Please go ahead.
Hello. Am I audible?
You are audible. You may proceed.
Hello. Yeah. So, sir, as you mentioned couple of the...
Sorry, could you just speak a little louder, please? Thank you.
Yes, sir.
Yeah.
Hello. So you have mentioned a couple of price hikes during the quarter. So can you share some more light on that? I mean, the segment-wise, or how much price hike we have taken during the quarter, and still we are expecting any price hike in Q1 or Q2? That is my first question.
Yeah. So largely in line with the increase that we saw in the brass cost that we had. So mid-January, we took a 15% price increase in faucets because there was a substantial increase from about 600 rupees to about 800 rupees. So 15% hike we took mid-January, and then on 1st May, we've taken another price hike of about 3%. So this is for faucets. In sanitary on 1st February, we took a 6% increase, and then gas prices obviously went up significantly in March and April. So mid-April, we took another 7%. So these price increases are to ensure that margins are protected. I think they've been based purely on what we've seen in terms of gas prices and raw material prices. But we've taken steps at the right time to make sure that margins are protected.
Okay, so whatever as of now the impact we are getting from the petrochemical price and all, so this price is sufficient to tackle those impact, or we are expecting some more price hike?
No, so at this point of time, they're sufficient. If we see more volatility in the coming weeks and months, we'll obviously have to take a call at that stage. For now, the price hikes that we've taken are good enough.
Okay. You also mentioned some new launches and all with the higher margins. So can you share some color on that, like the revenue mix and the from which segments we are getting higher margins, and from which region or from which market?
Yeah, so there are a couple of segments that we are focusing on, which average selling price as well. So within sanitaryware, we have smart toilets. So that is a category which is growing across the country, and we are also growing ahead of the market there. The other is thermostats. So that is something that is increasingly being used in consumer homes now. So thermostats is another category where we are seeing good traction and at significantly higher gross margin. Then even the regular product ranges, there are products which basically have design and aesthetics which are significantly from what is available in the market, also using raw materials. So we are launching a lot of those in faucets particularly. Those also offer higher gross margins. So between smart toilets, between thermostats, and between these better or differentiated design and aesthetic products, better raw material, these are the categories where we are seeing higher gross margin.
Okay. Okay, got it. My next question is on a pipe segment. Okay. So, what I observed that we had a negative price realization for the segment in FY 25-26. Please correct me if I am wrong, and even though in FY 24. So what is our expectation or management guidance on the price realization? The price will be on the same range, or we can expect some higher realization in the coming quarter or the coming year, like for FY 27-28? Hello?
Hello.
Yeah.
Am I audible?
Yeah, sure. Please go ahead.
So I'll repeat again. The output prices, the selling prices, is directly proportional to the input price, that is the raw material price. So the average selling prices last 2 years have been going down. ASPs are coming down, but there is a volume growth which is happening in the market. Now, what is happening is, as I earlier said, from January onwards, the prices went up from 68 rupees, and in March it touched around 114 rupees per kg.
Okay.
So, and now it is stabilized somewhere around 85 rupees. So if it stabilizes at that, definitely we are going to see a surge in average selling price per kg of the raw material and the finished product. So we will definitely see some better margins in future. And as such, as I said, we have been already doing this very good last April and May now.
Okay, so you are mentioning margin. So, if I think the margin is around 10% as of now for pipe segment, or pipe EBITDA per kg. So what we are expecting over there, like, from 10 to what we are expecting to 12, 15 or mid-teen, or what is the...
But it all depends, basically everything depends on what, where the raw material stays. Because if the raw material further comes down, we cannot give any guidance. We can only give a volume guidance for that. Because your end product and your end selling price goes down.
Got it. And my the second last question on the exceptional item which we have in this income statement side. So can you share some more color on that exceptional item or loss around 526 million? And what is the management expectation on this for FY 27-28 or midterm? So it's a one-off, or we can expect further into FY 27 as well.
So in Q4, when we talk about the exceptional items, so one big item is relating to our impairment, which has happened in the joint venture company, which is Hintastica Private Limited. So we had done a slump sale of this business from HHL to Hintastica way back in 2021. So there was a goodwill of about 35 crores around, which has been impaired because of the reasons that, the initial plan and the current plan which we are looking at, that venture is losing money. Although there is a plan which we have now, to build faster turnover on that joint venture and make it profitable, in the near future. So that is one. Another hit which we took during the year was on the, certain businesses which we shut down on the consumer side, which were more seasonal and they were losing. And as a result of which you will see that the performance of the consumer business in terms of a substantial reduction in the operating losses is very visible in the P&L. So these are one-off items. I think to a large extent, if you see in last 3-4 years, we had last few years, I'll say since 2015-16, under the Hindware brand, we had launched certain new businesses. I'll say 60-70% of that businesses, let it be pipes in terms of building the turnover, let it be consumer products in terms of building the turnover, and even the expansion of our faucets business
is there. So where we have not been successful in terms of ability to create a bottom line, although they were all successful on the top line, was the seasonal businesses, like, we're selling air coolers in the retail or fans business and water purifiers and air purifiers, so which has been shut. And now from the perspective of the business portfolio, four key businesses: sanitaryware, or we call it as a bathware business, which consists of sanitaryware and faucet business, pipes business, and kitchen chimneys. And also these are four clear verticals which we have demonstrated a growth, and we continue to grow there, and we're given the guidances.
Okay, noted. And the last question on the losses from the JV, which we have adjusted for our bottom line, and that number is significantly higher for FY26. So, any color on that? And what we can expect for near term or next 2 to 3 years?
So the higher quantum of loss is also on account of the goodwill, which I spoke of, which is there. But going forward, we are fairly optimistic that this business has good potential to grow. The loss-making activities, like we had set up a factory here, which we disposed of in the month of December. So a number of actions have been done. So, wherever required, we optimize our operations in terms of, making the overall growth which we have achieved on the sales over the last so many years more profitable on the bottom line also.
Okay. That's all from my side. Thank you so much, and all the best for the coming quarters.
Thank you.
Thank you. Our next question comes from the line of Vinod Krishna from Avendus Wealth. Please go ahead.
Sir, thank you. And sir, any guidance on debt and how it is going to pan out over the next 2-3 years on both the segments combined, like?
So on a combined basis, we have a net debt of 708 crores today. A big repayment is happening this year of odd 145 to 150 crores. We feel that after that 50-60 crores. So whatever is the accrual which we are generating is now going towards a repayment of debt, other than the small capex which we have to do to further ramp up our manufacturing efficiencies and also debottlenecking our capacity. So the growth we are generating will go towards the repayment of debt.
So is there any target where we will go and stop, sir, like at 300 crore, 200 crore, or we'll make it debt free?
So I'm not saying we'll make it debt free because in the next 2 to 3 years, but definitely a substantial reduction by almost 30 to 40% should happen in the next 2 years.
All right. Thank you, sir, and all the best.
Thank you. Ladies and gentlemen, to ask a question, you may press star and 1. Our next question is from the line of Aditya Banerjee, an individual investor. Please go ahead.
Hello, am I audible?
You are audible, sir. You may proceed.
Hello. Thank you for the opportunity, sir. So I have a couple of questions. So on the demerger side, sir, what is the progress with regard to the demerger, and by when do you expect listing of both entities?
So we had approved this demerger. The board had approved in March last year, subsequent to which we got SEBI or the stock exchange approval some in July. And after that, there have been a series of court hearings, and the shareholders and the unsecured creditors has also approved the scheme in their meeting held on 7th March 2026. We already filed a second motion application with the Honorable NCLT of Kolkata, for which the hearing has already happened. Order is reserved. We are waiting for the order. And after that, there are few more steps in the formalities as prescribed under the law. We feel that this may take another 2 to 3 months, in terms of getting the final court order, and after which we'll approach stock exchanges for the listing, which is another month and a half process based on our past experiences. I'm audible?
Okay, sir. And on consumer plan side, you guided 90 crore for Q4 FY26 with 100 CR by quarter 1 FY27, and quarter 4 came in at 80 CR, actually lower than quarter 3's 81 CR. So what drove this sequential decline? And is this 100 CR quarterly run rate target still intact for quarter 1 FY27, or are you revising the timeline?
Yeah. So, in quarter 4, there were issues in terms of raw material for a couple of our categories. So the coolers we sell through e-commerce, and cooktops and hobs, for example, there were issues in terms of supplies. So it was more an issue around availability of raw materials for certain categories, which impacted that 8 to 10 crores, which would have got us to 90 crores. In terms of the target, basically we will hit the 100 crore thing within quarter 1 and quarter 2 of this year. So we continue on that path of 100 crores in a quarter.
Okay, sir. And we are targeting double-digit margins over time under the outsourcing model. So what gives confidence this business can sustainably achieve such margins in a highly competitive category?
We are targeting the 8 to 10% EBITDA margin in the consumer appliances business within the next 2 financial years. So within FY27 and FY28, we should hit that 8 to 10% EBITDA margin.
Okay, sir. And you mentioned supply side challenges in the tiles business during the call. So could you help us quantify the expected impact in quarter 1, specifically in terms of volume loss in millions square meter or equivalent units, and revenue headwinds and any margin compression you are anticipating as a result?
So we had an impact in March of roughly about 10 crores in terms of non-supply of planned material that we had for tiles. In quarter 1 of this year, there has been improvement in terms of supplies in May. April still got impacted. So if I were to quantify the April plus May impact, then it would be about 4 to 5 crores in terms of the non-availability of material that we needed. We expect that situation to improve in the coming weeks of May, the remaining 9 odd days, and in June for it to stabilize. So we should get back to regular supplies from all our suppliers by June.
Okay, sir. Thank you. That's it from my side.
Thank you. Ladies and gentlemen, we will take that as our last question for today. I would now like to hand the conference over to the management for closing comments. Over to you.
Thank you, everybody who joined on the call. I think there have been a set of questions which have been asked, and I hope we have been able to appropriately answer your queries, which are still open to, any further queries. You can get in touch with our investor relations agency, and always happy to interact through them. Thank you very much.
Thank you. On behalf of Arihant Capital, that concludes this conference. Thank you all for joining us. You may now disconnect your lines.